Good afternoon, Joe.
Yes, hello, Jeff.
Yes.
All right, wonderful. Well, we'll get this session started.
And you can leave me out and just introduce Brad since he's had so many troubles already. But thank you again for having me this week.
Absolutely. Well, good afternoon, everyone, and welcome to the June 2025 edition of Epic Insight. This is Joe Corona. I'm the Director of Sales and Strategic Partnerships at Epic Retirement Plan Services, and I'll be your host for today's call. With a new administration comes changes to retirement policies and issues, and to help us navigate what is happening in Washington and how it can affect you, your practice, and your clients, we're excited to have with us one of our industry's foremost leaders in our industry, Brad Campbell. Brad is a partner with Fager, Drinker, Biddle & Reath, and advises financial service providers and sponsors on ERISA issues, including fiduciary conduct and prohibited transactions. A nationally recognized figure in employer-sponsored retirement plans, Brad is the former Assistant Secretary of Labor for Employee Benefits and the head of the Employee Benefits Security Administration. Brad has been listed as one of the top 100 most influential persons in defined contributions by 401k Wire, and has been listed as one of the top 15 ERISA attorneys in the country by a poll of the National Association of Plan Advisors. Your line will be muted throughout the call, but if you have any questions that you would like addressed at the end of the session, please enter them in the webinar control panel, and we will address them at the end. With that, I will turn it over to Brad.
All right. Well, thanks, Jeff. And just let me do a quick sound check, given our technical difficulties. Can you all hear me?
We can hear you perfectly.
All right. Well, you're fortunate then, because you can hear me, but you don't have to look at me. It's the best of both worlds for all of you. But thanks for putting up with some of our last-minute technical problems here. We appreciate it. And I don't know, maybe maybe the confusion of getting this call started is similar to the confusion some of you are feeling as you're looking at what's going on here in Washington and what's going to happen and what might happen and what has happened and what could happen. It's a fun time for everybody. I think a lot of folks, when you sit back and realize we're only I guess we're starting the 5th month, basically, of the Trump administration. We got quite a road to run still. And as much as has happened, I think we sometimes forget that we're still actually very early on in the beginning stages of this. So I thought we could talk a little bit today about some of the issues that are going on legislatively, a lot of the issues that are going on through executive orders and reorganizing or more accurately organizing the Trump administration at Labor and IRS. And then look at some of the executive orders and what they mean, and then the regulatory issues that DOL is considering and that are on the horizon for us. And unsurprisingly, there's a lot. This is an unusually active time. Let's maybe start with the Department of Labor and the Employee Benefits Security Administration. Daniel Aronowitz is the nominee from President Trump to be the Assistant Secretary for EBSA. He had a hearing last week in the Senate, his confirmation hearing, and he was very fortunate in that he was not the only person testifying. It was a 4-person panel, and he was fortunate in that he was the least controversial nominee on that panel. And in some ways, that's not surprising because employee benefits has always been an area where there's been a lot more bipartisan coordination than in some other areas. But he was on a panel with the nominee for head of OSHA and with a couple of nominees at the Department of Education. And the Department of Education people seemed to bear the brunt of the questioning from the committee. He only got a couple of questions, but his message and what he said in his testimony was I thought, very encouraging. What he said is that EBSA is an agency that needs a turnaround, that it is certainly going through some difficult times in terms of the staffing being down fairly significantly, and that it's an agency that needs a turnaround. And specifically, he indicated that he wants to focus on providing clarity and guidance to plan sponsors and plan fiduciaries so that they can more, I guess the word would be more confidently carry out their obligations, removing some of the ambiguity that has, in his view, fostered a lot of the recent litigation. By recent, it's the last 5 to 10 years at least, but in the sense that there's been a growing swell of ERISA litigation, some of which is fueled by ambiguities in standards, and that this is having negative effects in terms of chilling the innovation, chilling the adoption of new designs and new policies that would expand the availability of benefits. So he was very much saying he wants to reform the agency in a way that will result in being essentially more user-friendly to plan sponsors and plan fiduciaries, and use that then as a springboard to expand opportunities for benefits for workers. So I think that was a message that was pretty well received by the Senate panel. And I think I'll just put it this way, I think it's consistent with what I've heard from talking to other folks at DOL who are there, which is, yes, the agency is materially reduced. It's probably about 20% fewer staff than it was a few years ago, and that the agency has had some challenges recently. There have been issues, for example, some of the common cause arrangements that DOL entered into with the plaintiffs' bar, where they were sharing enforcement data in cases where DOL was not actually even a party to the litigation at issue. Been some very questionable activities taking place. Those of you who've had the misfortune to be involved in a DOL investigation of a plan in the last several years have probably seen that, as I have with the clients I've been working with, that those investigations are taking longer and longer to resolve, that technical violations are being treated more punitively than perhaps in years past, and that the results at the agency are showing this kind of lengthier amount of time. The agency is closing fewer investigations, significantly fewer, over the last several years than it has been in the past. And the backlog appears to be growing. We have a General Government Accountability Office report that was done in 2021 that looked at cases from 2017, and 4 years later found that 1 out of 6 was still open. So it's a lot of challenges at the agency that need some repair. I think the question will be, will the administration succeed in making reforms or succeed mostly in sort of breaking down some of the things that are there? And that's a question that we're going to see time tell more than others. So overall, I guess I would sum that up by saying I felt like it was a positive hearing and a positive statement from the nominee about where he thinks the agency is going. And based on that, I think it's quite likely that he will get confirmed. The timing on that's up in the air because Washington is always a place of politics. And while I don't think he personally is a source of concern, the big picture politics tend to govern when nominees get votes and when things are scheduled and how quickly they move. So we'll see what comes next on that. Looking also at the Labor Department, I think a couple of issues to bear in mind are some of the executive orders that the president has issued that are telling the Labor Department to take certain actions. There have been several that are directly relevant to retirement and employee benefits. I think one I would highlight is what's called the America First investment policy. And this was an executive order issued out of the White House that addressed a number of different agencies and looked at how are these agencies interacting and investing or overseeing the investment of assets related to what they called foreign adversaries. And one of the specific provisions told the Labor Department to update fiduciary regulations to essentially prevent the investment by ERISA plans in the securities of the companies of our foreign adversaries. Foreign adversaries is defined. It's a list of countries and includes countries like China, Iran, North Korea, Venezuela. There's a few others on that list. We don't know yet what the Labor Department is going to do in response to that executive order. The order has been issued. The department is supposed to be working on updating those fiduciary rules. Whether that is a regulation, whether that is guidance how stringent it might be is something we don't know the answer to yet. That's one of those provisions that, depending on how detailed it is, could actually end up being a significant amount of work for plan fiduciaries and their investment advisors to look at the investments in their plans. For example, if you have an international, mutual fund or an international-based collective trust, would that contain potentially investments that might run afoul of that guidance? Well, we won't know until we see it, and so we're sort of waiting to see how that issue is going to play out. Another one that is an executive order that's not directly on point to retirement plans, but I think is one we will want to watch closely, is actually in the health benefits space. It's directing the Department of Labor to issue regulations extending the 408B2 disclosures, which we're all familiar with in the retirement space after, I think it was 2012 or so when those went into effect. So we've been living with them quite a while, to extend those disclosures to pharmacy benefit managers. And one of the questions I think we're going to see there is there any material change in how 408B2 applies? And the reason I say that is one of the big criticisms or debates around pharmacy benefit managers are the nature of the rebate, the nature of the internal pricing within those services. And if there is, for example, a Labor Department initiative to use 408B2 disclosure as a way to pull apart and look inside those pharmacy benefit managers to see how all the different pricing and so forth is occurring for pharmacies, pharmaceuticals rather, is that going to have a parallel into the retirement side, where currently we don't pull apart certain types of investments to see what the internal spreads are? For example, guaranteed products of various sorts, which we don't see currently under 408B2 inside to determine what the internal costs and benefits are to, for example, the insurance company issuing that. So there's questions, I think, as to how that rule will be interpreted for pharmacy benefit managers, and in turn what that might mean for retirement plans and some of the retirement investments, to the extent there's sort of common new interpretations related to those disclosures. Again, that's one where the department's been ordered to pursue a proposed regulation on this. It's part of a much broader administration initiative on healthcare matters, on pharmaceutical costs. So we're going to have to wait and see the details of that proposal and what some of it means. More generally, I think it's important to note that there's a lot of questions we don't have answered yet about the regulatory process the Trump administration is going to use, other than what the executive orders have suggested. So there is a deregulatory executive order, which essentially says that agencies need to remove 10 old rules for every new rule they want to put out. And as an aspirational goal, that's a pretty clear statement that the Trump administration wants to be deregulatory. One of the questions, though, is what does that mean in the real world? If an agency is putting out a rule that's mandated by congressional action, so for in our space, rules that would relate to the Secure 2.0. For example, the Labor Department is directed to issue a regulation on adequate consideration in employee stock ownership plans. That was one of the requirements of Secure 2.0. If they comply with that mandate and put out the rule, does that mean they also have to come up with 10 separate deregulatory rules? If, for example, they put out a proposed rule that is itself deregulatory, let's say they put out a compliance assistance rule that simplifies reporting for various plans, combines some deadlines, makes compliance easier on 5500 and summary material modifications and all the other variety of reporting and disclosure documents. Would that rule also be, even though it's deregulatory, have to have 10 separate other deregulatory initiatives? How they're going to apply this in practice, we don't yet know enough to see, because again, we're only in month 5. And so far, the president has been directing agencies to begin doing things, but many of the things they've been directed to do, they've not yet had time to get done. So we're going to have to be watching as this process goes forwards to see how efficient the government is going to be in dealing with the regulatory process and making some of these changes. Taking a quick look over at Congress, and particularly at the One Big Beautiful Bill. And I got to say, I love that name for this, the One Big Beautiful Bill. I've been waiting for people to start calling it, OBBB or some clever acronym, and not sure that that's actually catching on. But if we look at that on the retirement side, that bill has mostly ignored us. It has some associated related elements. For example, the Trump accounts for putting assets in for children as they age to be able to fund various educational and businesses and other things. It's kind of a tangential related provision, but it's not really about retirement plans. And I think some folks are trying to decide, well, is that a good thing or a bad thing? Is the fact that we're not big players in the One Big Beautiful Bill, is that a lost opportunity, or did we dodge a bullet? And I have to say, I think I'm in the camp that we dodged a bullet, because if you look at the process by which Congress is considering the One Big Beautiful Bill, the tax bill, I think our downside risk, if we're included, is actually much greater than the upside potential. Why is that? Well, to answer that question, we got to look at the exciting world of Senate procedure and the filibuster rule. So in the Senate, with 100 senators, normally you have to have 60 senators vote to end debate. So if you can't get 60 senators to agree that we should stop talking about a bill, you can't call the vote to then pass it with only 51 senators, a simple majority. You need that kind of supermajority to stop talking about a bill. There are relatively few exceptions to the filibuster rule. One of them is what they call the reconciliation process. And this isn't new. It's something that's been around for 30 or more years. It's been used in a variety of circumstances. What it essentially says is when we're doing these big budget bills, they're going to get special consideration, and we're going to waive the filibuster rule in the Senate. But that comes at a price. The price is the only provisions that can be in that bill through the reconciliation process basically have to deal with revenue, with debt, and with spending. So what you can't put in a bill through reconciliation are policy directives that aren't fundamentally affecting the budgetary aspects of things. So if we look at Secure 1, we look at Secure 2, both of those were bills that were relatively short on spending issues or revenue issues, though there were, of course, some. They were long on policy pronouncements. Make this change, Labor Department, do this regulation, Treasury or IRS. Here's a new type of benefit that could be included in your plans. Here's a new type of benefit that must be mandated. So, some of those had a revenue impact, but a lot of them would not be eligible for this tax bill they're considering because they're using this reconciliation process, which allows them to avoid the filibuster. So most of the things we might want to see in a Secure 3.0 probably fall into that policy bucket. There are things like improving portability or addressing clarity around fiduciary obligations for this issue, or creating a safe harbor for fiduciary action on the other issue. Those really aren't eligible for the bill. What could be eligible for the bill would mostly be changes that are potentially negative. Things like, hey, to get this deal done, we need to raise some revenue. What if we lowered contribution limits slightly? That would raise some revenue. What if we Rothified some more things so that we put more money in on an upfront taxation basis instead of a behind, on distribution tax basis? So I think the risk we would face in actually getting a bit of a haircut in the retirement space is greater than the beneficial provisions that might make it through. So I'm going to say that the fact that we are not part of the One Big Beautiful Bill in any material way in the retirement space is probably a good thing. Let's remember, though, that this is a process that has just started, really. The House has passed a version of the bill by one vote, I would add, and the Senate is in the process of considering a bill and deciding what they want it to look like. They're going to make some changes. The House might not like those changes. So there's a lot of political infighting, even among the Republicans, to get this bill through all the hurdles to get it to the president's desk. And I'm sure you all followed the various criticisms that have occurred from the former Doge leader Musk and some other, folks out there criticizing the spending in the bill, the overall deficits. There's a lot of political road to be run to get that bill across the finish line. The flip side, though, and the reason there's a lot of pressure to do it, is that many of the tax cuts people are currently relying on expire starting next year. So if this bill doesn't pass in some substantial form similar to the 2017 Tax Cuts and Jobs Act, extending some of those expiring provisions, there's going to be a significant tax increase essentially on everybody. And so there's a lot of political pressure to fight about the bill, but there's also a lot of political pressure to get it done because of the ramifications of not finishing it. So in terms of Congress, I think probably they've spent a lot of time getting President Trump's nominees through the process. They're spending a lot of time on this tax bill. These really are the primary issues that the legislative process is actually focusing on. And in some respects, this is difficult. This is different than we have usually seen. President Trump has been rather unique in focusing more on executive authority, executive orders, getting government to do things affirmatively through the executive branch, and less on the legislative process. This big tax bill is kind of the different approach, the one where he really is having to get Congress to work with him. And so they're right in the thick of negotiating all of that. Let's talk about a couple of the regulatory priorities that the Labor Department is dealing with right now. One of those is the fiduciary regulation. In the Biden administration in 2024, they issued a new final rule that would expand the definition of fiduciary advice to include pretty much all recommendations related to not just investments within plans and IRAs, but also rollovers or transfers to or from plans or IRAs, roll-ins to plans from others. And it was a pretty dramatic expansion of what would be considered fiduciary advice. And it also made some real significant changes to conditions imposed as a result of that fiduciary status. In order to execute some of those advice transactions, now that the definition's expanded, you would have to have more financial professionals using what they call exemptions of various sorts. And those exemptions were also modified with a lot of new conditions and requirements. That regulation was scheduled to go into effect last September. It was stopped in court. There were two separate lawsuits in Texas in two separate district courts, federal district court in Texas, where the judges in both of those cases, within a day of each other, issued orders staying the rule from going into effect. In other words, they didn't rule on whether the rule was valid. They said, while we decide whether the rule is valid, we're going to draw the line and stop further application of this rule. So for right now, the 2024 fiduciary rule is not in effect. The Biden administration, before it left office, appealed to the Fifth Circuit Court of Appeals, and the deadline for responding was in February originally. Of course, the Trump administration took office in January, and so they went to the Fifth Circuit and said, hey, we need more time to review this. We're now just coming in, new leadership, need time to figure it out. They requested an extension. They got an extension of 60 days. They requested another extension. That second extension actually expires next week. So we'll see what happens next. Probably the Trump administration will ask for a further extension, given that they're still organizing. Well, they have most of the cabinet, or pretty much all the cabinet officials in place. They're still putting in place folks like Mr. Aronowitz, who are the sub-cabinet officials running the individual agencies. So we suspect they'll probably ask for a further delay. The question of what will their substantive policy be on that regulation is one we don't have an actual official answer to. While we don't think the Trump administration actually shares the Biden administration's views on the specific regulation, and probably are likely at the end of the day to rescind it or modify it in some material respect, we don't actually know what their policy is going to be, because in the first Trump term, they did support expanding fiduciary over some rollovers. and did so through guidance that was issued in 2020. So it's not 100% clear what the Trump administration's policy on especially rollover recommendations is going to be, assuming it's not the Biden rule that's currently being litigated. That's another one where we're going to have to wait and see exactly what policy positions they take. We do know what they plan to do on the so-called ESG rule. So the Trump administration had put out a regulation in its first term that sought to say fiduciaries may only select investments based on what they called pecuniary factors, and that you cannot make investment selections based on non-pecuniary factors. Pecuniary effectively meant factors that are likely to have a material effect on the economic performance of the investment. And that regulation technically went into effect, but the Biden administration immediately announced that they would not enforce it and that they were going to replace it. And they did rescind the Trump rule that was never enforced, and they replaced it with a Biden-era rule that was much closer to the original regulation. Essentially, it retained fiduciary decision-making based on an analysis of all relevant factors. And it said that ESG factors in particular could be relevant depending on essentially their materiality, and that they could be used to break ties. And it also loosened some restrictions on proxy voting and shareholder activism by ERISA plans. The Trump administration, that Biden-era guidance was litigated. It's also stuck in federal courts, again, in Texas and the Fifth Circuit, challenging the validity of that rule. And the Trump administration recently announced in filings in those court cases that its intention was to rescind the Biden rule and replace it with a new regulation. So we're likely to see a revisitation of the first term Trump administration rule, the so-called ESG rule, but which is really more broad than that. It really relates to how all investment decisions are made by fiduciaries and how they should consider what they need to consider as part of their prudent, thorough, and well-documented process. So we're going to see what comes of that process. We don't have a time frame for when they might move to rescind the current rule. We don't know if that's going to happen through the court supervised process, whether that's just going to happen as a regulatory matter, and how long it might take them to propose a replacement. But that's another area where we clearly have some anticipated action coming up from the Trump administration that would ultimately affect fiduciaries, because the regulation it addresses really is covering the waterfront of how fiduciaries make investment decisions, not really just the ESG issue, at least as it's currently been promulgated as a rule. Take a little diversion here and look at litigation issues writ large. There's been several new developments in the courts on ERISA litigation. And I guess I'd start by saying you can look at ERISA litigation as a glass that's half empty or half full. There's a lot to support the half-empty, more pessimistic view. The last couple of years, we've seen record high levels of ERISA fiduciary class action litigation, and it's been branching out. So it's not just fees and whether fees are too high, but it's also getting into some new areas. And you could also put in the half-empty category some recent decisions about rules and process about how courts consider these cases that are going to make it easier for lawsuits to be brought. So let's look at a couple of those on the glass half empty side of the litigation space. One of the new areas we're seeing a lot of litigation occurring, and there's been at least 50 plan sponsors, large plan sponsors sued over this. It's the use of forfeitures. And we've been suggesting to a number of our plan clients that this is an issue that ought to be on their next committee agenda, to take a look at the forfeiture issue. First, let's make sure we're all on the same page. What are the forfeitures we're talking about? Well, essentially, forfeitures are where, and here's a classic example. Let's say you have 3-year vesting in your plan. So a participant is making elective contributions, and they're receiving matching contributions. Well, after 3 years, they're fully vested in the matching contributions. They're always vested in their own contributions. But let's say I'm with the plan, but I leave after 2 years. Well, in that event, my own contributions and earnings I get to take with me and roll over wherever else I'm going to go. But the contributions that were matching, I didn't vest in because I didn't stay for 3 years, if the plan provides that approach to vesting. So there are now assets in the plan that were the employer's matching contributions, but which are no longer assigned to that particular participant. Many plans have commonly said, okay, well, let's use those contributions to offset the matching contributions we'd have to make for another employee. So in other words, Sally left and she left behind these matching contributions. Bill has started working with us. Let's use these contributions that are in the plan to match Bill. So we're assigning them to his account as he's going through earning matching contributions. That is a permissible use of those plan assets, of the forfeitures that are in the plan. The IRS has long held that position. DOL has never disagreed with that position, and it's one of the more common uses of forfeitures among plans. The question is coming up in this litigation is not really whether that's a permissible use. The question that's coming up in the litigation is, well, wait a minute, if these are plan assets and they're in the plan, then forget about whether it's a permissible use under the tax code. The question is that they're asking in this litigation is this a breach of your fiduciary duty if the plan says you may use these either to offset future employer contributions or to offset the expenses for existing participants? In other words, each participant's going to pay X amount for record keeping. Why aren't you using those forfeitures to pay that record keeping fee? If you have a choice between those, and if you, the fiduciary, chose to use them to offset future employer contributions, they're alleging that you've breached your duty to act solely in the interest of the participants and beneficiaries because the fiduciary chose to, in essence, benefit the plan sponsor rather than benefit the plan participant. So it's a very creative argument that the plaintiff's bar has come up with. And so far, it's been about 1.5 years now that these cases have been working their way through. So far, a good number of them have been dismissed by courts using some variation of the argument of, well, no, these were plan assets contributed for matching purposes, so allocating them from one participant to another is a perfectly appropriate use and is not a breach of fiduciary duty. These haven't been finally decided, but issues like, should we dismiss this complaint at an early stage or should it go on to the next level? So some courts have dismissed these cases earlier saying, nope, that looks okay to us, in essence. Other courts have looked at it and said, well, no, I mean, that's an argument. You're saying a fiduciary had a choice and they chose the plan over the participant. That is an issue we're going to have to let get to the next level and have a discussion about that. So we haven't got really any of these cases that have worked their way through the whole court process, but we've seen a large number of these filed making these allegations. So one of the questions that we've been getting from a lot of clients and talking to clients about is, well, what's the real risk here and how do we address it? Is there something we should do to address it? And I think it boils down to 3 questions that plan fiduciaries and plan sponsors should ask. The first one is, what does our plan document currently say? One of your fiduciary duties is to follow the plan documents. So what does your plan document say? Does it say you may use a forfeiture either to offset employer contributions or pay plan expenses, or does it direct that you do one or the other? So what does the document currently say? Question number 2 is, what are you actually doing? Because if your plan says, thou shalt use these to pay participant expenses, and instead you're using them to offset employer contributions, this isn't a new problem. This is an old problem. You've always been supposed to do what the document says, and if you haven't been following that, then that's a problem by itself. So 1, what does the document say? 2, what are you actually doing? And then 3 is, what do you want it to say? What do you want to do with forfeitures? And in cases where plans can amend their documents, some plans, and this isn't the only way to address this, but some plans are saying, well, what if we were more specific in our plan document? What if it says you will use forfeitures first to offset employer contributions, then any remaining amounts to offset participant level plan expenses? If you write it in that way, then that may remove this fiduciary choice because there's no discretion. The fiduciary needs to follow the plan documents unless they're contrary to law. And it's unlikely, given that the tax code, as the IRS says, permits using forfeitures for this purpose. It's going to be a very difficult argument to say it's contrary to law if your plan document directs the use of forfeitures for offsetting employer contributions. So essentially hardwiring that plan document may turn the argument that this is a fiduciary decision into an argument that this is actually a settlor decision. In other words, a pre-fiduciary plan decision. So, normally I'm not in the business of saying, let's look at what the plaintiff's bar is doing and then respond. We have a long history of looking at ERISA litigation where the thing they were suing you for last week that says, for example, you should be picking passive investments over active because after all, passive is cheaper and nobody beats the market forever. Those same trial lawyers will turn around and sue you for the opposite, which is, hey, you're using only passive investments. And by the way, they're underperforming relative to the active investments for this past period. That's a breach of your duty as well. So generally speaking, the best way to address potential fiduciary risk is to have a prudent, thorough, well-documented process and to do things essentially the right way. And so normally I'm not one suggesting that what's the plaintiff's bar doing, let's respond to it. I think this one's a little different in that there are some risk mitigation strategies you can take. And plus, I think a lot of plans haven't looked at their forfeiture provisions in quite a while because it hasn't been a hot button issue until recently. And so I think this is one of those issues that I would put on the agenda for, consider putting on the agenda for the next plan committee meeting to say, hey, what are we doing with forfeitures? Is it working? What do we want to do? And take a look at that issue. Another couple of items that I think we would be recommending people put on their plan committee agendas are missing participants. This is one of DOL's favorite enforcement topics in recent years. About half of their civil recoveries have come from missing participants. And just so we're all clear on exactly what that is, when I work for you and I'm a participant and I'm an employee and a participant in the plan and I'm making contributions, when I leave your employment, I don't have to leave the plan. I can leave my assets in the plan. I remain a plan participant even if I'm no longer an employee. And I have all the rights and obligations of all the other participants. Over time, some folks never roll their money out. They leave it in the plan. They retire. They move to Florida. They do whatever they do. The plan loses touch with them. And DOL has taken the position that you have a fiduciary obligation to furnish disclosures to plan participants, to stay in touch with them. And if we're getting to the point where they're at retirement age, they should be taking required minimum distributions, or they should be getting their pension because they're at normal retirement age for the plan, and they're not because you've lost touch with them, that if you can't show that you've exhausted sort of the reasonable means of finding these folks, that they're now a missing participant and you have fiduciary liability for not being in touch with them. And so DOL has put out guidance that offers a variety of things you could try to try and find these folks. What we've been talking to clients about is the importance of kind of getting in front of this issue. And one of the easiest ways to start is by talking with your record keeper and TPA about what does our plan do when we have someone who gets a return to sender on their quarterly benefit statement. What's the process? Do we flag that? Do we try and find a better address? Do we, what do we do to try and get back in touch with that person? And a lot of record keepers offer enhanced search options such as death records and credit searches and so forth to try and find these folks so you can repatriate them with their account and get back in touch with them. Yeah, this is one where there's administrative reasons why you might not want to have a large number of missing participants in the plan and the issues it presents. So you can do a lot of things to try and clean that up, to find these folks potentially, if their balance is less than $7,000, you can roll them out of the plan into an IRA. There are a variety of ways to deal with it, but it's one of these issues that's worth getting in front of, because we have a much easier time defending a client who has a process, and then the discussion we're having with DOL is, was the process appropriate, than it is to have a client who hasn't addressed missing participants at all, and DOL's question is, well, boy, that sure looks like you're on the hook for a breach here since you haven't done anything to address this. So missing participants, because it's an issue that's been pretty common, it has administrative overtones as well, is one that we would suggest getting in front of. Another issue, and then maybe we should stop and see if there are any questions, but the last issue I'll mention is some of the Secure 2.0 deadlines that are coming up, in particular the Roth provisions. Unless the IRS gives us another reprieve, right now we are scheduled to have the mandatory Roth-only catch-up contributions starting January 1 of 26, so starting January 1 of next year. If you have employees who, for this same employer in the previous year, made $145,000 or more, based on the FICA calculation, so it's not the normal highly compensated employee test, it's a different test, and they want to make catch-up contributions, they can only do so on a Roth basis, which means plans that don't have any Roth features currently need to figure out how to address this issue before January. And there is guidance out there from the IRS. Record keepers are working with their plan sponsors to address this, but that's one of those issues that should be on your agenda to make sure that you've got a handle on how to address it so that those issues are going to be compliant when the next deadline comes. Well, like I said, we can certainly keep going. There's no shortage of things to talk about, but maybe this is a good time to stop and see if you have any questions or other issues we want to address.
Well, thank you very much, Brad. And we will open the floor up for a few minutes of questions. So if you would like to run one by us, please enter it into the question panel in the chat section. You actually just addressed one of the questions, which was if you anticipate if we will receive any further clarification on the mandatory Roth catch-up that is coming up in January of 2026.
Yeah, it's a tough one because well, I'll just to add to what I said before, there is a possibility we could get there's a possibility we could get a further deferral. On the other hand, the IRS as an agency has been sort of materially affected by staff reductions. We still don't have an IRS commissioner. I don't think there's been a hearing yet. I might be wrong about that, but we're still in a situation where the IRS as an agency is having some difficulty doing a lot of things because of where it finds itself. I don't think you can wait until the last minute and see if you get lucky on this one. I would start talking to your record keeper, especially now, and have a plan for dealing with this, because you're going to need time to decide what to do, decide how to do it, and then provide notices to all the participants. So if you start backing up from January 1, how long it's going to take to provide notices, how long it's going to take to let a contract, how long it's going to, or amend your service provider agreement, looking back to deciding whether you want to amend it and how, you kind of need to be starting by now. So I don't know that you can really wait and see if we get lucky.
Absolutely. One of the questions that we receive at Epic is obviously with the 403Bs and the ability to invest in collective investments. Any new updates that you can share on that front?
Yeah. So that issue has been a big one. And the good news is there is fairly strong bipartisan support for allowing 403Bs to invest in collective trusts. The bad news is that there is no obvious legislative vehicle for Congress to fix the problem. As we discussed before with the One Big Beautiful Bill, the tax bill, because of the reconciliation process, it's pretty likely that that provision is not an eligible change that can be on the bill. It really doesn't relate materially to revenue, debt, or spending. So chances are this won't be a vehicle that can be used to fix that. On the good news side, though, the House Financial Services Committee just about 2 weeks ago or so passed a bill at the committee level that would provide, and they called it essentially a parity bill. Essentially, the argument that's holding a lot of traction is 401k plan participants have the benefit of access to collective trusts, but 403b plan participants don't. That's not equitable given some of the benefits of this as an investment option. And that part had pretty wide support. I think only 8 Democrats in committee voted against it. And their concerns revolve essentially around whether collective trusts are equally protective of sort of retail investors as mutual funds would be. What was also interesting in that hearing, though, was there was an amendment offered that would limit the ability to use collective trusts only to ERISA-covered 403b plans. In other words, ERISA plans, 403b plans, the nonprofit 403bs, for example, non-governmental nonprofit, would be able to use collective trusts, but not the governmental 403b plans. And that amendment actually got mostly Democrat support. So it's kind of interesting to see the way that's breaking along political lines. Ultimately, I think this issue will be passed. It's just when will we have a vehicle to which we can attach it, and how much longer will that take?
Great. One of the questions came in was related to your comments on forfeitures and the use of those forfeiture dollars. The question is, can we use those forfeiture dollars to pay employer safe harbor contributions?
I think so, but I'm going to have to just put a little asterisk on that one, because that is the kind of question I would ask one of my colleagues who speaks. I like to joke that I speak tax, but it's not my native tongue. And that's one of those questions I would be confirming with one of my colleagues. So I'm going to give that how about a 80% confidence yes, 20% confidence I'd ask somebody who really knows what he's talking about.
Absolutely. Going back to the Roth catch-up, this next question reads, the way Section 603 reads, it sounds like all catch-up contributions must be Roth. Should a plan sponsor have a form for employees making less than $145,000 to elect pre-tax catch-up?
I don't know that you need a form for that, because essentially it's being triggered by the income status. So really, this is a situation where you're going to have to look at what is a fairly the good news is it's a fairly administrable test, which is for this employer in the prior year, did this participant earn more than $145,000 as judged by the FICA rules? And that really is kind of a yes or no question, and all the information you need to answer that is already in the possession of the plan sponsor. So I don't know that you need any kind of election form from the participant. If they're below that amount, they don't have to be catch-up contribution. Of course, your plan can have participant contributions being on a Roth basis. That's already, that's been current law for some time. You can have your plan structured so that participant contributions can be elected to be Roth only. So I don't know that you actually need an election form for that, other than the plan design change.
All right, wonderful. Well, that looks like it covers all of our questions for today. So we would like to thank Brad Campbell and Jeff Jones for joining us for this Epic Insight webinar. And as a reminder, we will be posting a copy of this presentation out. As always, please don't hesitate to contact us if there's anything that Epic Retirement Plan Services or our partners at Federated Hermes can do to support you and your efforts. Thank you, and we look forward to seeing you again on our next edition of Epic Insight.
Thank you all very much.